In this video, I'm going to be going through examples of what I already showed in the first video. So if you didn't watch the first video, go and watch that one so that you get better understanding about what I'm going to be showing you in this video, because this video is more about showing you examples in the chart as to how the liquidity stuff is working. And this is only one technique I use. There are other ways I do it too, because the market is so fractal and you need to understand in every situation what you should be looking for. But this is the most accurate one that is working very well, and I want to show this one, and then we later get into the other ones step by step. I'm not holding anything back here. So let's get into this. We have this example here. So if you look at it here, you need to mark the structure first. I will do a video on the structure for the next one, because if you don't understand the structure, then it becomes very difficult for you to understand the liquidity. But you need to get the liquidity idea first, then the structure comes later. It isn't that difficult. So we take this high here. This high here is a major high. Why? Because it took out this low. If it's not a major high, we expect it to hold price like this and go up from this move here, but it didn't do that. It took this one out and then took this one too out. So we consider that a potential major high, and then it came and created a low here. This low is also potential until it breaks this high. So price went and now broke that high. So we have now our major high and then our major low being marked out. So this becomes our major high, this becomes our major low. It's very important to be able to identify these price points, because they are very, very significant in determining the movement of price. Now, using those 2 points, you have to draw a line like this, and you have to wait till it breaks. So as it has broken, you need to trace price and see the low that caused the break of that structure, that this structure high here. So price came from here, it went back, dropped more liquidity into this, we'll talk about this later, and then came, created this low and went all the way up. So if you look at it, this low is the low that caused the break. Hence, this low is the liquidity. It's as simple as that. That low becomes the liquidity. Price can go to wherever it wants to go to. If they want to take a big move, they will come back, take this low out, and then price will move up. So in this case, that is how we have seen it. It came back all the way. They took this liquidity here, and then this could be your entry, and then price move up here, I think over 400 to 500 pips. So that is the first example for us. So this is the second example, and as we can see, I have already marked the major high and then the major low. Price push. If we put a line here, we can go through and see that something broke it. Which low caused the break? You mark that as your liquidity. Simple as that. So let me take a screenshot and then we can write on it. So this is our major high, and as I'm even doing, you are learning the structure bit by bit. And this becomes a major high because it was able to take out this low that was created before that high. So since that low is taken out, this becomes a major high. Don't worry about all this price action. It will create a low. This low becomes a valid major low if this high is taken out. So when that high is taken out, then we can call this low a major low. Since this high is taken out, our concern is to identify the low that caused the break. So you have to trace price. So if we trace price from where it came down here, and then it pushed up. This time, consider the wicks. The wicks are very important. It's not the body. Use the wicks. So if we trace price, it went and then broke this major high, and the low that caused it was this high, this low, sorry, and price came all the way down and took that low out and move up. Retrace and then continue the move. So that becomes our liquidity. It is as simple as that. If you can identify this and identify that, trace which one caused the break, and the low that caused the break would be your liquidity. They will take that guy out and price will move. So that is it for the second. So if we look at this example here, we can see how it is already turned up. I think this was a very big move, and you can see from the price action, it can tell you exactly the way price would have moved if it comes back to the zone. So we start with our lows and then our highs. So if we are selling, then you have to consider the low first. The low that took out any high here becomes a potential low, and then it went all the way up, creates a high. That high becomes a valid high if it breaks this low, and immediately the low is broken, then you can mark those 2 points as major high and major low. And within those two, you are now waiting for the one that will cause this break. So let me make this much clearer. If we draw this, you can see from here, market came all the way down to the wick here. Consider the wick. Now all you have to do is trace and see which guy caused the break, and you can see that this was the movement that caused the breakdown, and that high becomes our liquidity. Do not worry about whatever price is going to do here. You can even trade this in the lower time frames too, using the same technique we are doing. The price is fractal, so in the lower time frames it happens the same way in the higher time frames. But stay with one thing, else when you try to be caught up with every move, then you will get yourself fucked up by the price. So we move from here, price came all the way, and then look at that, we took out the liquidity. Immediately they take out the liquidity, the job is done. They need to move, and then price run all the way down. You could target this as your TP, or you hold if you know the higher time frame intentions. We will come later and then deal with that using a storyline. This becomes our next example, and you can see we start with marking our structure. So we pick this high. Why? Because it took out that, and it was supposed to take out this, but it couldn't. So since it couldn't, that becomes a potential major high, and we wait. If it breaks it, price came all the way down, did what it has to do, and then came and broke it. So if it breaks it, we have the low here. We can identify the low here, or you can even take this low if you like. But normally what is our interest is the low that caused price to what? Break this high here. So if we watch very well, we can see, if we draw this, we can see that this low here is the one that led to the break of that structure. They will normally drop this, come drop something again. That is more liquidity feeding into the real level. This is what most of the YouTubers show online, and they show you only this. But if you don't understand the market is coming here, this is going to be a very big problem, because you will be looking at this. This is not the real thing. The real thing is here. This guy that caused the break is the real low market is trying to tap into, and after that they have to move. This is just an inducement, putting people to get into the buys. More should buy, and then later they will come and stop them out and then take out the real move. So if you understand this, you will be able to get it all the time. And sometimes too, the low that caused the break can be like this low, and then they will come and drop the same low to it before they come to sweep it. And most people will draw some things like this, and you think that okay, it comes, you see it in the price action, you try to use patterns to understand it, but it will not work. I have been in this journey for a long time, and I understand that understanding only the patterns without applying the logic to it is going to lead to more problems. And you would think that okay, maybe liquidity doesn't work, but it does. You just need to understand it from the point of logic. So I've shown about 3 or 4 examples. This should be the last one. I don't want to make very long videos because it doesn't help. You just need one single idea. Go and practice over and over. When you get it right, go to the next one. So here, this example was very clear, and this is also something that you need to learn something new, because this one we can see here, this was the major low, and then because it took out that and it took out this, we created a high here. That high got this low to be broken. Now we have to trace which high caused the break. We can see very clear this was the high that moved and then broke it. That break becomes the liquidity. You can see very well when they came, they just tap into that. Immediately they take that liquidity. That is it. They are going to run all the way down. But look at the interesting thing here. Before they ran down, they created the same exact thing in between. So you could even take this as another trade. You could have taken this and then take this one as the second trade for this movement. If you look here, we have this low here. Now you can see that this low push this high all the way up, so that becomes our potential major low, and it came all the way down. Something broke it. If we draw it like this, and this now becomes the potential major high for the one that is inside. So we'll have to trace and see which one caused the break. And I told you, always trace with the line chart. If you take it from here, you can see that all the candle came to this point before it retraced. You have to draw it all the way down to that point, because when this bullish candle opened, it went down first, and that is what you need to know. You need to understand how the price was moving, and then the high that caused that is where our interest is. Sometimes too, they do that, they create the high. This is not the high that broke it, but they create another high that matches the high that broke it. And then in this case, you see, they created this, create another one before they break. Consider those two highs. It's very important. It's just like relative equal highs. So those two highs all will be taken out, but most importantly, just consider the one that caused the break. That is what you are going to be able to use to identify where the market will come. As to whether it takes this high out or not, pay attention to the one that caused the break. And the one that caused the break is here. Price came, they took that one. Look at how interesting it is. Always when they take that, that is it. The job is done. They don't need to wait. They have to run all the way down. When we get into this more and more, you can also wait for confirmation around this place and be able to take it. You can also add trend lines and be able to take it. You can also add setups here that I use, and then you can be able to take it. If you get very good at it, you can use only the liquidity as entry and just respect the stop losses. If it's not going to work, it's not going to work. If it's going to work, it's going to go smoothly. So that is it. I think this is about 4 or 5 examples. This should be able to clear any misunderstanding. See you in the next video.